Hello and good morning, everyone. Today we are going to present our project for the finance for growth and for entrepreneurial risk management. For this project, our group members are Anne, Angelica, Jacopo, Michael, and me, Azimad. Today, the company we have chosen for our project is Applied Material Company. Applied Material Company is American-based company that is located in Silicon Valley of California. The company supplies the equipment, services, and softwares to enable the manufacture of semiconductors across the globe. The company was founded in 1967 by Michael McNeely and others. The company went public in 1972. The Applied Material diversified until James McMorgan became CEO in 1987, which brought back the company's focus to their original idea that was manufacturing equipments. The current CEO is Gary E. Dickerson, who was appointed a CEO in 2011, who has spent 18 years on various roles inside the company. In 1984, Applied Material became first semiconductors equipment manufacturer to open its own technology in Japan and first of its kind to operate in China. Today it's operating globally in Europe, Japan, Israel, China, Italy, North America, and Taiwan. We have chosen this company because it's a growing company with having huge income statements, revenues, balance sheets, and equities data, which are really helpful in explaining the financial terms.
Now we start with analysis of the company. Cash from operating activities from 2018 was 3.8 billion, which reflects net income adjusted for the end of depreciation, amortization, compensation, and income taxes, and changes in working capital components. Working capital was 6.7 billion at October 28, 2018. Capital expenditure were of 622 million. Capital expenditures were primarily for real property and investment. Investment in technology to allow to access the new market opportunities or emerging technologies. At the end of 2018, the aggregate principal and estimate fair value amount of long-term debt issued were both 5.4 billion. Most of the data we used obtained from AMAT's 2018 10K report. We calculate the next figure and we compare the result with online financial resources. From the income statement, we took the net sale from the company, 17.253 million. Then we discounted the cost of product sold, 9.436 million, and the total operative expenses. And we obtained an EBIT of 4.796 million. After subtracting the interest and taxes paid, we got a net income of 3.313 million. The tax rate used is the effective rate tax for the company in 2018, 29.4%, having income taxes of 1.3 billion. Totally liabilities of 10,934 million, from which 4,068 million represent total current liabilities. 1.254 million are the income taxes payable, and other liabilities are 303 million. The remaining 5.309 million is the amount of the total long-term debt. For calculating the weighted average cost of capital, we used a CAPM formula, where the cost of equity was calculated using the Modigliani-Miller theorem of considering the advantages for firm to be levered, since corporation can deduct interest payment, and also to see how the cost of equity rises with leverage. The cost of debt capital was calculated by using the coupon bond formula. We multiply the coupon rate on the company bonds by 1 minus tax rate. AMAT is the highly levered company with a debt to equity ratio of 1.60. This is a common amongst large companies because debt can often be a less expensive alternative to equity due to a tax deducibility of interest payments. But if you calculate the debt to equity ratio by just taking into consideration the long-term debt, we obtain a debt to equity ratio of 0.78, which is less than half. This can mean that most of the company's debt is based on current liabilities and income taxes payable. October 2018, AMAT total long term was 5.30 billion. With this growth in debt, the current cash and the short-term investment levels stands at 3.5 billion for investing to the business. Moreover, AMAT has produced 3.78 billion in operating cash flow during the same period, resulting in operating cash to total debt ratio of 71%, which means that AMAT's operating cash is enough to cover its total debt in 1.4 years. It also means that the company is able to generate 0.71 cash from each dollar of debt capital. Its cash flow coverage seems adequate to meet obligation, which means its debt is being efficiently utilized. This may mean a high managerial ability to deliver maximum return from minimum investment and a coverage of 2.9 years for the total liabilities with a cash flow to total liabilities of 34.58%.
The leverage ratios were calculated for assessing the ability of the company to meet its financial obligations. An equity multiplier ratio of 2.6 means that assets are mostly funded with debt than equity. However, Applied Materials' return on equity is of 48.44%. That is above the industry return on equity of 16%. That shows that the company made outstanding use of shareholders' funds and it used its assets more efficiently than US semiconductor industry average last year. According with the statements, that was done by improving its net income and repurchasing shares. The degree of financial leverage of 1.05 indicates that, as we said before, the company has been financing its growth with debt. This can result in volatile earnings because of the additional interest, but we must consider that the interest expense is very low with a cost of capital of 4.43%. We got a market value for Applied Materials of 44,000 millions, where the market cap at the end of 2018 was of 34,000 millions. The market value of debt was obtained by taking the book value of total liabilities as one coupon bond, and then to value this coupon bond at the current cost of debt for the company, getting a result of 11,000 millions. And the cash or cash equivalents are 1,951 millions. On the other hand, the total assets of the company is of 17,790 millions, made of 10,950 millions of total liabilities and 840 millions of equity, equivalent at 61.55% and 38.45% respectively, which give us a debt to equity ratio of 1.60. Then we obtain a price to book value of 4.65, and comparing with the price to book value online of 4.5, we can conclude that is a trustworthy number. After that, the net present value of growing opportunities was obtained by subtracting the invested capital from the market value of the company, having as a result a very positive net present value of growing opportunities of 33,056 millions, so Applied Materials is creating value for its stakeholders. Finally, the probability of default for the book values of the company is 13.18%.
In order to evaluate the growth of the company, we have simulated the growth of the free cash flow to the firm for the next 5 years by at growth rate of 10.77%, which is the expected growth rate by the company managers. Also, we have calculated the discount rate and the present value of cash flows, so we can have an idea of the real value of them. In order to calculate the value of growth, we have to compare the value of steady growth company with the value of steady state company. Doing the calculations, we have found that the value of steady growth company is almost 116 billions, and value of steady state company is almost $78 billions. And our value of growth is more than 38 billions of dollars. So in order to sustain the growth of the company at rate of 10.77%, the company has to invest more than 4.88 billions of dollars in the next 5 years. This investment will provide them an return on investment which is higher than 700%.
So for our hedged and unhedged part of our analysis, we decided to analyze Applied Ventures, which is a part of Applied Materials which invests equity capital in seed through early stage companies. It represents the unhedged part of our investments and value creation, since all investments is done with capital which is not backed by any type of cash flow. The aim is to contribute to the competitive capabilities of the firm by appropriating new technologies without having to merge with any kind of company. Up to 50 millions are invested every year, with a mean investment of 6 millions for company and expected returns after 2 to 6 years. Our first simulation actually takes the present value of the unhedged capital in 2018, which is equal to 89 millions, and capitalizes it for year 5 with a cost of capital of 1.72%. The value we obtain in year 5 is equal to 196.8 millions. We then show the implied returns from operations, calculating them with taking the value of equity in year T+1 and subtracting the value of equity in year T. The reason we can use only value of equity is because actually equity represents 100% of our value creation. The choice of introducing leverage is actually linked to the minimization of the risk linked to the complete dependence on equity holders' behaviors, since in order to achieve leadership in the sector, it is important to manage to keep a quick decision-making process. Our cost of capital is maintained at 1.27%, since no payment will be done until year 11. We capitalize the value for year 10 and we obtain 200 millions. We then compute the level of debt which is allowed by the probability of default of 13%, which is the probability of default of the company, of Applied Materials, and we end up with the value of debt of $132,000. We actualize the value of debt and then we study how the value of debt grows according to implied interests. The same process is done for the equity part of the analysis. Since this value creation is going to add up to the value creation of Applied Materials, we can consider it to be really important, and one of our propositions for the firm as a whole is actually to focus on the managerial part of the risks connected with Applied Ventures. In fact, entering new markets and the actual survival of the new firms on which we are investing is a source of risk that is not entailed by the whole company. Our conclusion is that applied ventures represents a good example of a quantum leap strategy, as it gives to the whole firm the opportunity of appropriating a value that it could never have appropriated through classical production processes.
Besides doing calculation, our team also conducts some market research and analyzing applied materials SWOT analysis to have a better understanding the current business situation before we have some concluding and making suggestions. Talking about the strengths, applied material products have really strong brand recognition in the semiconductor industry. This has enabled the company to charge a premium comparing to its competitors in the semiconductors. In fact, 2018, Intel referred quality suppliers awarded to this firm. They also have a long history and currently the leader of the semiconductor market. Weakness in 2018, the firm had observed the decline in the sales revenues due to the decreasing of electronic devices, especially smartphone and high-end products, which affect the firm in both manufacturing chips and displays. Screens. Applied indebtedness and debt covenant could adversely affect its financial condition and business as well. Manufacturing interruption, delay, or failure also a problem since they have a wide geographic presence. Opportunities. The world talking about the 4.0 industrial innovation, artificial intelligence, Internet of Things, and autonomous driving like Tesla's, which promises a really high demand, not just like come from smartphone nowadays. Also, the gaming market, graphic democratization, cloud servers also is where customers always long for the better and cheaper solution. And this also the long-term strategies of applied material. Talking about threat, it's also clearly that the higher the growth of mass obtained, the higher the risk the firm is facing. The board member also clearly aware of that, and in the 10K, they have clearly included, but we just take out the three most concerned issues. The cyclical markets, which we also consider as the fluctuating markets, where require a really high ability to predict and catch up with the change of technologies as well as a diversified ability. Environment policy is also the macroeconomic issue, Trump and the world trade with Chinese, for example. Also, the increasing in the number of competitors enter the market. Based on the calculation results and financial reports as well as the current positions of the company, our team came up with some conclusions and proposals which AMAS could take into consideration to maintain the high growth rate. The financial reports and the calculation has shown us that the company is doing really well at present, despite the fact that it has slowed down a little bit. However, this comparing is compared to the pace of growing in 2017. Furthermore, since the firm is highly growing, applied material do need more funding in order to maintain the expected growth with nearly $5 billion US. It seems quite huge, but number looking at the return of investment is also really high, 7.7. Applied material is a worth to invest firm as well. They also have proved that they have a positive growing company which is creating value for investors. In fact, they have long history consistent of paying dividend to stakeholders. Also about growth driver, as we mentioned before, the rising demand for semiconductor and display as by the emergence of Internet of Things, big data, and 4.0 industrial innovation is a tailwind. We believe that applied material is in a great position to grow sustainably and profitably based on its strong pipeline of enabling technologies, supported by expanding opportunities on the semiconductor, service, and display front.